Hi, I'm Dan Hobbs. I'm one of the tax partners here at Carpenter Box, and I just wanted to give a brief summary of my thoughts in reaction to yesterday's budget and the various announcements that were made that affect businesses. So I guess my opening thought really is that yesterday's budget was certainly a lot kinder to businesses than last year. Obviously, the kind of big changes to minimum wage, employers' national insurance have created a lot of extra costs for business this year. I think the Chancellor was very acutely aware of that and tried to kind of minimise the impact to businesses as much as possible. Thankfully, there weren't really too many tax measures that were announced that affect businesses, particularly ones which negatively affect businesses. That being said, we did see some more above inflation rises to the national minimum wage and national living wage. Now, that clearly is going to affect businesses that employ a lot of lower paid individuals more than those that have higher paid people. I imagine that's going to affect the leisure, entertainment, hospitality sectors quite a lot. That may be offset slightly. The Chancellor did also announce that there will be some business rate savings for businesses in those sectors. How much that turns out to be, we'll have to see, but certainly a reduction will be welcome. I think one of the other key announcements, which is going to affect a lot of businesses, the changes to salary sacrifice for pensions. So the Chancellor announced that the first £2,000 of pension contributions made under salary sacrifice, and that's where an employee has agreed to reduce their salary in exchange for enhanced pension contributions from the employer. The first £2,000 still qualify for relief from national insurance for both the employee and the employer. Any contributions above that threshold will be subject to employers and employees' national insurance in the normal way. Now, how that's going to be administered in practice, we don't know. HMRC are going to consult on that, but the good news is we've got until April 29 before we need to worry about that. So for most businesses, I think it's business as usual for the time being. Continue with current arrangements and review the position once more details come out. Beyond that, there were some other kind of measures which are going to have a minimal impact to most businesses overall. There was a change announced to capital allowances, which reduces the writing down allowance for kind of plant and machinery from 18% to 14%. That's only really going to affect businesses with very high capital expenditure or indeed brought forward capital expenditure from many years ago. The full expensing regime still exists, so for a lot of plant and machinery, 100% of the value can be written off in year one against profits. So it's really only going to be assets which don't qualify for that or kind of long-standing capital allowance pools brought forward. So it shouldn't make too much of a change to kind of many businesses that might be interested in watching this. There were also some changes announced to the EMI scheme for businesses which provide share options to employees. The thresholds for qualifying businesses have been increased substantially. So now some quite large businesses can benefit from the scheme, those up to having up to 500 employees and no more than 120 million gross assets. So that is quite a big expansion for kind of, say, SME businesses, but will include some smaller, large businesses as well. So that'll be a welcome change. There were also some announcements changing the qualifying thresholds for EIS, where businesses can have up to 30 million of gross assets and still raise investment under the EIS scheme. So again, that will be welcome, but I think it will affect only the minority of businesses that might otherwise be raising funds under that scheme. I think another interesting change that was announced in the budget relates to EOTs, employee ownership trusts. Now, there's been an exemption for a while now where business owners can sell their businesses to an employee owned and operated trust, and the gain they would otherwise realise on the disposal of those shares to the trust would effectively be exempt from capital gains tax. Under the changes, now only half the gain will be exempt from capital gains tax, with the remaining 50% subject to capital gains tax at the normal rate. So it's still a very beneficial relief for anyone looking to sell businesses to employees, but not quite as generous as it was previously. But I would actually say my big takeaway from the announcements yesterday for businesses actually relates to owner operated businesses. So lots of entrepreneurs, and that relates to the dividend tax changes. So the Chancellor announced that she would be increasing the tax rate on dividends by 2% for basic and higher rate taxpayers, but interestingly, not the additional rate of tax. So a small relief there. And 2%, it doesn't sound like a lot. And in the grand scheme of things on those bands, it has a limited maximum impact, but nevertheless, that is an additional cost for owner managed businesses that operate through limited companies. And I think what that really means is that the most tax efficient structure for running your business and indeed extracting profits from the business has kind of never been more nuanced. There isn't a kind of a default right or wrong answer about how you should do that now, and every case really needs to be considered on its own merits. So I think owner managed businesses are certainly going to want to review their current profit extraction strategy, or indeed consider whether or not they have the right kind of business structure. So overall, not too bad a budget for businesses. So if you have any questions or want to know more, then please get in contact with your usual person at Carpenter Box. Thanks.